now that we've got the basic ground rules together, as I mentioned, I've got questions in from Edison, and I've got questions, it looks like, from Greg, and of course Robert was first. But before we do that, let's get to our questions that came in via email. Todd asks, now looking at the proper married put structure, radioactive trading with 6 months out on the put, I noticed the options liquidity is not there for a lot of the trade. Most of the ones that I see have less than 10 contracts of open interest, maybe even just one strikeout. Is that a concern, or can we enter those positions as long as we get a decent mid-price? My concern is not purchasing the put option that has blow but needed to adjust down the road while I'll still be able to do it. I was looking at an ally position and Funko, I believe, FNKO last week, but the open interest was not there, and I wanted to get a bit more clarity. I noticed that ally for the front months, their activity is much more liquid, but that is not the case for other symbols. Okay, so same screenshot a little bit from last week related to Todd's question. The basic structure I would use for radioactive trade, and this was last week's price, ally is actually around 35 right now, but I would have purchased ally at about 32.57 and bought the March 35 put at around 390. Right? So that's about 3 strikes in the money, 2.5 really if you look at it that way. So the total invested is $36.47. It would be $3,500 total guaranteed exit. So worst case scenario, I can get 35 back for the put, so my risk is only 4%. This sort of answers another question, the second question from Todd, excuse me. So I could choose to go to one strike in, the 33 or the 34, and it might have had a higher risk of 6% or 7% or 5%, depending on the price. Okay, but this is the structure that we use. Buying farther out in time, which actually gives me a lower cost per day. The 35 strike that's 6 to 8 months out in time is not 6 to 8 times the cost of the near month 35 strike. It's actually a lower cost per day, even though you're paying more up front. We always want to sell shorter term, buy farther term. Now, I'm just going to read this real quick. We're going to take a look at it. I'm not going to read much of this, but my initial response to part 1 is naturally these further out options are going to have lower action. All the action is up front. There's more sellers up front than there's sellers out long. They do want to find a seller to a buyer. What I really want to focus on is that the underlying security is liquid. I'm not worried about, let's say, the March option only having 5, 10, or 15 contracts where the near-term options are at 40, 50, or 100. Okay, I'm not worried about that because typically I'm only opening a position with 200 or 300 shares, looking at 2 to 3 contracts. So as long as the open interest is greater than 5, then I have no issues, and I haven't had any issues getting it filled at midpoint, even on that far out option. Sometimes it's a little bit above the midpoint price if it doesn't trigger in the first 20 or 30 minutes, and I'm fine with that. So the search, and we're going to take a look at this in a moment, but I did see some today on Ally and FNKO that came up. And the FNKO only had 2 contracts of open interest for the farther out option, which might have been a concern for me. But we can take care of that very quickly using the tools on PowerOptions, and that's what we're going to do right now. So when I go into PowerOptions and I go to my strategy, I'm going to go right to married put, and we're going to go right to the search. Now I see the criteria that comes up initially. And you see here that I've added the open interest field. What color did they choose for me today? They chose pink. So I'm actually going to change it to green again. I prefer green. All right. So I've added the open interest field, and you can sort of see what Todd's talking about. There's a couple positions here on the first page. There's 36 total results here. And some of them only have an open interest of 1 contract, 2 contracts. There's the Funko one he was talking about. FNKO at 27.42. The 30 strike put is at 5.30. This is 9% in the money with a risk of 8.3%. We'll get to that in a moment. But it only has 2 contracts of open interest. If I'm only opening 100 contracts, Todd, I'm okay with seeing this open interest of 2. I'm kind of okay with that. But if I was opening 200 or 300, I might want to look for something more. Some of these puts have a very strong open interest. 96 for JD.com, 260 for Horizon Pharmaceutical, 4,565 for Citigroup. They match the criteria of what we want to see, and they have the open interest that you'd expect to see shorter term. But yes, on average, the farther out, there's less activity. And that's not a concern, number one, for what I mentioned, is that normally based on my account size, I'm probably only opening 200 or 300 shares of the position in my account. And posted on RadioActive Trading, it's just 100 shares in one put, just to, keep the math simple when we post our fusion trades. But if you're concerned with the open interest, that's perfectly fine. If you're more comfortable with a higher open interest, that's perfectly fine. So we have 36 results here total. And I'm probably only going to pick the top 2 or 3 after I do my research and analysis. But we can just scroll down into the parameter field, as we can in any strategy, set the criteria to where we want. We've got our default risks in here, the time frame we want for the preferred radioactive trade and the married put search. And let's just change the open interest to greater than 10. Naturally, this is going to remove some from our results. But we still have those ones that we saw, and we still have 21 total results. And again, anything ranging from 15 contracts, 12 contracts of open interest to 60, 96, 4,565, 157 for the ConocoPhillips trade. Okay? So if you want to adjust it, it's perfectly fine. Personally, I've never had a problem, even only with an open interest of 5 contracts or 4 contracts or 3 contracts, getting filled near the midpoint that I want. And what you're seeing on the search, by the way, is based on the ask price. So some of these risks that are 8.2, 8.5, and so forth, the higher percentage risks, are based on the ask to show you the worst case scenario. So if I get filled at midpoint, I'm actually going to get a better risk. Now, the reason why I'm bringing that up is this goes back to the second question that came in from Todd, part of his second question. And there it is. The second question is related to Ally and FNKO position. Outside of the liquidity for these two positions, I found a good combination that it could have made the acceptable max loss 5 to 6%, 6 months out in time. But upon inspection, I noticed that FNKO price, the put price, was 33% of the stock. The Ally one was much more reasonable. Is there a certain point where the price of the put compared to the stock is just too high and not worth it? A simple answer to that is yes. The more complex answer is no. Okay? And here's the reason why. I agree with you that I probably don't want to go to 30 to 33%. Now, when I answered Todd's second question, I told him that when I looked at the prices for FNKO, it was the one we saw. It was a put option at 530 with a stock trading around 24.75. And so the current prices, when I saw it today to answer his question, it was only 19%. The $5.30 was 19% of the underlying stock price. When he saw it, it was at $9. That would have been 33% of that current price on FNKO, or the price a little bit last week would have been around a $9 put. So I wasn't sure if the position he was from Todd was looking much further out in time, not looking to March or to January, but was actually showing an FNKO position that's further out in time, or if it was deeper in the money, and that's why it had that lower risk of 4 or 5%. Okay, so let's take a look again one more time. I'm going to go back to PowerOptions real quick here. There we go, popped up. You all should be seeing that now. Still back on the same search. I'm going to try to find the FNKO position that popped up. In order to do that, I've got to take the open interest out. We're going to put it back down to 0. Remember, the FNKO position had 2 contracts. And here it is right here. Funko's at 27.42. February 30 put at 5.30. The risk is only 272. Okay, so the put is $2.60 roughly in the money. About half of the total cost. So that 260 you're guaranteed to get back. So really the time value cost and the time value risk is only 272, or 8.3%. Okay? Now a lot of times I'd probably prefer to take this one, although the risk is high at 8.3%. That's going to relate to Charlie's question coming up next real quick. But when I'm doing my research and analysis, one of the steps I talk about in the other webinars is I'll always go to the search by symbol once I've decided on a position. Okay? Now here's more along the lines of what you're talking about. The February, we're out to February, so that idea that I presented to him about being further out in time, it only goes to February. So there wasn't a further out in time for this particular position. But if Todd had come across the 35, look, there's about that $9 price, about $33 on the position. And the risk is at 3.6%, sort of on the lower range. And when Todd was looking at the position last week, the prices might have been subtly different. But the reason I wouldn't enter this married put is not because the ask price is too high. It would be automatically filtered out because we don't go more than 20% in the money. And personally, I like to stay around 15% in the money, okay, around that range if possible, with keeping my risks in the range of 5 to 6%. This one is a little bit high. It's at 8.3%. Going to the 35 would give you the lower risk. But what am I doing? I'm buying a stock at $27.42. You'd be buying a 35 strike put, which is about $7.60 in the money, okay? 27.6% in the money. When I open a married put, it's because when I look at the stock chart and the company information and do my analysis, the strike price I'm selecting not only has to match my risk tolerance and my risk threshold, but it also has to meet what I need, meet what I need for my expectations, meaning that I'm likely to open the 30 strike because I expect that in 30 to 60 days, the stock might be trading at or near 30. I would only take the 35 if I had an expectation that in the next 45 days or so, the stock would move up 27, 25%, be trading close to 35. If that was my expectation, I might be doing a different strategy, to be honest with you, something with a little bit more leverage or a little bit more upside as well. So that's sort of part of the selection. It's not about the price of the put to me in relation to the underlying stock price. I would say that 33% might be too high, Todd, but it's this range here. The filters are already set up not to go more than 20% in the money. Okay, now you might have wanted to go there because the risk was in that range. It was in that 4% range at the time you looked at it. You thought it might be a better deal for the lower risk, but that is too deep in the money. Right now, as of today, this one is too deep in the money, wouldn't have shown up in my list. I wouldn't trade the 35. My focus, if I was going to do FNKO, would have to be on the February 30. It's the only one that is within the range that I like. It's a little bit high. It's the furthest out. We can't go past February 2020. So if you really liked FNKO, you thought that stock was a good bullish play, this would honestly probably be the only strike that would match the criteria for a good radioactive trade. I wouldn't choose the 35 personally, okay, but I would look at it and see why. So it's the range in the money we want to filter out. And just as we talked about before, if you're concerned about the open interest levels that you're seeing, if you're concerned about the risks being too high, this will relate to Charlie's question in a moment, just change the settings slightly. You're still going to find good candidates and a good number to select from within your needs. What do I mean by that? Let's take this down to less than 15% in the money, as I mentioned. Let's take the risk down to, let's say, 7.5%. And let's put in an open interest of 10. Okay, so 3 subtle, small changes. I still have 17 total results, all with the criteria I want to match my needs. And I have risks in the 4%, 5% range, risks in the 6% range. Here's some more 4.8s and 5.1s as well. Oh, sorry, folks. Let me get out of that. Okay, so that's the simplest answer. Focus on that range in or out of the money. And you also might want to make sure, in addition to customizing the search, you can customize the columns. Add in the percent in the money and the open interest range to your fields so that you don't have to look at it on the option chain or for further analysis in that aspect as well. Okay? So Todd, that's what that's my sentiment on yours, my feelings on yours. I think it's okay to limit the search results to be less than 15% in the money. Okay? And that'll take care of your concern about the cost of the put being too high. That FNKO one at 33%, it must have appeared at one point because it was just under 20% in the money, and it had the risk of at least 4% or so. That's probably when you saw it last week. But to me right now, that 35 is too deep in the money. That's the one that has the 33% of the underlying price. I wouldn't even look at it. because it's about 28% in the money. I'm keeping it less than 15. And then you can change the open interest to be greater than 5 contracts or 10 contracts. 1, 2 simple clicks. You've got the search results you want. 17 is still a good number because you're probably only going to select 1 or 2 of these. Ally position is still there. 5.5% risk. Only 2.9% of the money. Looks pretty good to me. That's one that I talked about last week I was going to open, and I didn't open this week. JD.com I looked at briefly as a new one for fusion traders for next week. I won't do eBay again. You know, it's sort of like the old X, right? It's burned me once and I'm not going back to you, so I'm probably not going back into the eBay position again. Okay, so that covers, I feel, what Todd's questions are. You can do that. I am comfortable with an open interest of 5 contracts depending on the number of shares I'm opening, Todd. You can change it any way you want to. Now, quick follow-up question. I might not go through all of this because Charlie isn't even here, I don't think, but he did send in an email, and I always promise I'm going to cover it. So Charlie actually sent this email into Kurt. Kurt didn't have time to answer it yet today, so I figured I'd address it here while we're on the topic of Mary puts. So from Charlie, he says, I've read the blueprint, I've been reviewing the fusion lessons, but my market sentiment personally is not bullish, neutral, or bearish. I feel with current political climate, the rapid market fluctuations due to news, what we've talked about the past few weeks, headline-driven news, has been affecting all of our positions. It's not a good time to start a radioactive trade. Now, I did some paper trades and power options in August. Only 1 out of 5 has any rollout opportunities. A rollout opportunity will appear if one of 3 things happens. If the stock moves up that 3 to 6% in the first 20 to 30 days as we expected, the portfolio tool will show you rollout opportunities. If it falls a little bit, you might see rollout opportunities as well. And if it's been stagnating for a certain amount of time, you might see a neutral rollout opportunity. The 12 different income methods we discuss in the blueprint, some are designed to work best if the stock goes up, some are the best if the stock goes down, some are the best if you're neutral but an event's coming up, or if it just looks like it's going to be neutral now. There's ways around that too. All right, so only 1 out of 5 has opportunities for rollouts, and they aren't very appealing. And I think he went on to say, when I looked at the old lessons and the information when we were back in 2008, old trades from 2011 to 2013, the risks were better. Most of the radioactive trades that come into power options are closer to 9% and very few are at the 5% level discussed in the blueprint. Okay, well, we just sort of disproved that, didn't we? We added some basic filters to put the risks down in that range. Yes, there were some at the 7%. The Ally one we were looking at and the Funko one was at 8.3%. If we got filled at midpoint, it would be lower. But you can use the search tool to control that, to find specifically what you want. And the earnings per share growth on some of those ones that were in that list were very favorable. I'm looking at it on the other screen right now. We'll go back to it. But 56% earnings per share growth on the first one that only had a 4.7% risk. 30% earnings per share growth with a 5.6% maximum risk on the third trade that came up in the search. So Charlie then says, is it possible that market makers are purposely limiting the amount of puts or inflating the prices to keep people from using the strategy? No, I think the answer is more along the lines of volatility. As volatility has spiked because of the headline news, because of things that are still there as well, we're looking at positions that have a little bit more inflation to them and a little bit more movement as well. And that's why you're seeing higher risks. But again, I still find multiple positions whenever I'm doing a search that only have 4, 5, or 6% risk. And personally, my target, by the way, is about 5 to 7%. That's where I think the good targets are, is going in the money enough on a good moving stock where my risk is 5 to 7%. I think 4 is too low. I think below 5 might be a little bit too low or too deep in the money where I need more upside in order to be able to make adjustments. Now, going back to the first part of Charlie's question with 1 out of 5 positions and rollout opportunities, let's go back to power options very quickly, and then I'll start going through all the other questions that came in. I apologize. I just clicked on the wrong screen. There we go. Okay. So again, just real quick highlight. With those changes that we made and related to Charlie's question, the first one here, that risk of 4.7%, with 56% earnings per share growth. 5.6% with a 30% earnings per share. Sure, there's 7% in here. Nothing above 8. Nothing above 8 on this list that we just corrected. Here's some more 5s, 5.1, 5.2, so they're still there. Okay. Now, related to the August question, and you said you paper traded some married put positions that didn't technically show you, let me go back to this map here, didn't technically show you what you wanted to see. Only a few of them have, I apologize, only a few of them have rollout opportunities or moved up the desired 4 or 5% in the first 30 days where it'd be a good idea to do an income method. Well, that's not necessarily a fault of the system. And that is not a fault of your structure either. It's not a fault of radioactive trading or fault of the structure. As you mentioned, it is a fault of the market. Not a fault, but it is just what happens. If you opened married puts in August, let's say the end of July, beginning of August, what was the first thing you saw? Well, 600-point drop in the Dow. Okay, so every position you started would have moved down. If I opened positions on August 1st and saw this decline, and I expected the market to recover, I likely could have used an income method to lower the cost basis on the position so that when it did go back up, I'd be at a profit level here instead of at break even. One of the income methods, income method number 9, allows you to sort of average down and cut down the cost basis on the position if you're expecting it to move back up. If I expected a continuing decline, well, I might have missed the boat here, but if I expected a continuing decline, I might have used income method number 12. Okay, so that's part of the concept. Of course, none of these not necessarily would have shown a profit, but because of the market turmoil, you didn't lose money down here. Because you own the put, you didn't have a stop order where you've gotten filled at the loss and not been able to take advantage. See, if you just used a 5% stop order on any of the stocks you bought here, you probably would have been triggered out at this point and missed this to get back to break even. Now, sure, you could have bought more stocks here if you felt comfortable and gone back up as well. But with the put, I could have just rode this down, rode this back up, and now I'm almost at a place where I'm ready to do an income method again. Okay? So I understand it, but it's based on what happened in August. Also, that being said, because I feel it is my goal to sort of help investors understand this concept that I use in my personal trading account and that I promote, let's go back. Let's go into the back test real quick. And I'm going to open married puts on August 1st. We're going to take the straight search I would have used if I was opening puts on married put positions on the 1st. So the back test is going to go back, show us exactly which trades would have matched the radioactive criteria on August 1st. See some common names in there. Altessian didn't do good. I think it's at the 120 level now. Now I don't know if that was related to earnings. No, it wasn't related to earnings, just had a bad time. But Viva Systems in there. I know that took a huge hit as well. Kirkland Gold is in there. So yeah, this is the list I might have chosen from. This might take a while because in the background we're uploading the history, but I'm going to calculate group results. I just want to show this as an example. And Charlie had mentioned that only 1 out of his 5 positions have any rollout opportunities. Well, the goal to do the bullish side is you need a 4 or 5% increase. That was probably hindered right away because of that steep decline in the first week, and then the second steep decline 2 weeks later. And now we're gradually moving back up. If you opened a position, we're going to do that too, hopefully, if it comes in fast enough. If it doesn't come in fast enough, I just won't waste time on it. Still not there yet, okay? Well, I looked at this earlier. As it's churning its numbers, and while we're loading the history in the background, Charlie, I looked at this later. Those positions I opened on August 1st would have had about a 53% success rate. It was 8 out of the 15 trades had a profit. One of the profits was as high as 13% on those first 15 trades. There was an 8% gainer in there. I think there was a 6% gainer, and the others were only around 1 or 2%. But the 7 that lost, only 1 was at a full near loss of 6.5%, and I think that was Altessi and the team. I think that's why I mentioned it. It stuck out in my head. It had dropped 20 points or so down to 125, 126. So it was at almost the full loss. But all the other ones were only at a loss of 0.9, 0.8%. That's pretty respectable for buying a bullish position here, going through all of this where you could have made adjustments, and then having it come back to this time frame where you're winning at about a little bit more than half of them, and the average gain over that period for those 15 trades was 0.9 or 1%, I believe. Not great. Not great as an average return. But again, that's what you expect with a hedged position. I'm looking to try to earn, realize, or see a 1 to 1.5% return on my position every 30 days. And if I don't, I might back out of it. Okay? But that was sort of in the goal. It's still not there yet. Oh, there we go. Oh, I'm sorry. This one was, oh, I know what I did. Okay. So 2 here. 2 today. Friday, September 13th. Only 7 out of 15 were successful. Average return is 0.6%. There's that 14% gain on Mastech. The 5.4 only on Solar Edge. This one was at 9% earlier today. Is that Viva? No, it's Marriott Vacations Worldwide. The Altesian is at the near full loss. It's only 5.7 now instead of 6.5. So yeah, 1, 2, 3, 4. 4 positions I could do income methods on right now. I know that's not a lot out of 15, but other than Altesian and Viva, I'm not really seeing big losses, and I'm seeing a small profit on the average, even with that massive decline in the broad markets, that Dow 600-point movement, and then that other fluctuation a week and a half later. The numbers I was referring to, I think, is that if I ended it on 8/30 for 1 month, if I changed the end date to 8/30 instead of looking at today, September 19th, 13th, if I did it there, yeah, look at this. Okay, so 7 out of 15. I don't know where I got 8 from. Something, I must have looked, I apologize, ladies and gentlemen. I must have looked at July 30th instead of August 1st. That's okay. But here again, only 7 out of 15 were successful. The average return is 0.9% over the same time period that SPX was down 0.9% in QQQ. There's still a 12% gainer in there as well, still a 4.3. The largest loss in the first 30 days is 3.7. Yes, Altesian at 3.7, which is worse now, I admit. But there's that 9%, or there's that other one there. Solar Edge Technologies, 10.6%. Okay? So I understand the situation, and I feel for you, and we want to help you improve it to do better. But think of what you would have been in that same time frame if you had done covered call positions where you would have been at this point. And then if you rolled down the covered call because you were worried, and then you had to roll them and buy them back here, just see them fall again, then you roll down to try to cover your hedge, and now the stocks are up here, and you've got to buy this back at a higher price just as you did here. I'm sorry, here, because the stocks moved back up. It would have been a worse scenario. Okay? It was a whipsaw effect for every strategy. So I understand it. Is it a good time to do married puts? My answer is always going to be yes. Okay? Sure, I could sit here and say, oh, if I had done a long strangle and bought an out-of-the-money call and out-of-the-money put, and it fell here, and then I moved it back up here, and then I rolled the call when it was up, and then I sold it, the puts, when it was down, and bought another call and wrote it back up. Yeah. Do you have time for that? Is that how you want to trade? If it is, well, Sam will chime in and tell us how well he's been doing with it. That's kind of what he does. He does 2 to 3 month strangles, I believe, out of the money strangles, and then he sells calls and puts in between them on SPY and other things. And he's been very successful from what he's told us in the webinars doing that. But it's intensive. You've got to time it. The married put is more of a smoother ride over time. And you're not going to have a good month every month. But let's go back 6 months real quick here. Naturally, of course, I can pinpoint and say, look, if you had bought positions in June, in the first 30 days, you would have had 5 positions to do income methods on. You would have done another income method in July, and then you hit this August mess. If you would have bought new married puts at September 1st, not that that's how we trade, but if you had, you could see here, you'd probably already be doing income methods as well. You know, so it's the timing. That's just the timing of the market. This would have been a bad time too, May to June. You can see that. You would have seen positions just going down, but all of your losses would have only been 4 or 5%, if that. Might have only been 3% because your put still probably would have been out to January or further at that time. Okay, so I still think it's a good time to do it. There are different ways you might want to consider opening the married put if you want to put in the extra capital to maybe open it as an income method number 12 in that case. Okay, all right. Okay, so that wraps up our email questions, and I hope everyone got some useful information out of that. Let's go back to the main page now, and I'm going to take your emails. I'm going to take your questions as they've come in, ladies and gentlemen. First and foremost, I'm going to scroll down to the bottom here. Okay, there we go. And okay, this is why I had to come back here. Let me see if I can go back one screen. Come on, just give it to me again with all the right settings. A comment, I will need to check the comments. Todd said, is the lower percent in the money better for those trades? If it matches the rest of your criteria, yes. What do I mean by that? Okay, so lower percent in the money. Where's my percent? The lowest. Am I in the history? Oh, I'm sorry, I'm in the history. Let me go back to the search. Is the lower percent in the money better? Well, it depends. Okay, so Oriental Financial, you know, it's right at the money. The 2247 is at 22.5. It's an 8.4% risk, only 0.1% in the money. So what makes this easier is I could apply an income method right now and sell, let's say, a 22.5 call, Todd. But if I open this married put, it's because I thought the stock was going to move up 5% in the first 30 days. Why would I ever sell a call right away? Okay? Usually the risk is higher too. If you want to control it to a closer risk of, let's say, 7.5 or 7, whatever your preference is, and put in your open interest. What else did we change? I apologize. Oh, the range in the money. We dropped it down to 15. Okay? I have no statistics to prove that they're better. What it does mean is that those that are closer, see, now the 11.3 one came up because the risk is gone. Right? I took it out. I told it that it couldn't show me anything that had an open interest of less than 10 contracts, and I lowered the risk to 7.5%. So it found me another position on OFG which matched my criteria. This is the 25 with 4.5%. So again, let's take a look at that side by side as we want to. So which is better, the 22.5, which has an 8.4% risk and is right at the money, or the 25, which is a 4.5% risk? Throw out the open interest idea. Don't even worry about that. They're both at 20 and 25. Ignore that. Well, where do you think the stock's going to go, and what is your risk tolerance? If you think the stock's target, you know, in the next 30 days or so is only 24 or 23, I'd say the 22.5 would be better, but you're taking on almost double the risk. That's what it is, okay? So what's better? Depends on your risk threshold, what your trading plan is, and your success rate is. I would typically probably go with the 25 in this case. Maybe not. It depends on the situation. I just think this is too high of a risk for me. You saw that. I put in 7.5 and it went away. Okay? So that's the answer to that question. It's a balance. It's always a balance. And Fernando chimes in with that to help too, and he says if the risk on the married put is too low, okay, and he means, you know, if it's in this range, 2.2%, the ability to do income methods is now limited drastically because you have to wait for the stock to get closer to this put strike price for the income methods, the bullish income methods, to make sense. 25 is not that bad here. It's only 11% in the money, a 4.5% risk. But if you're comfortable with taking a risk at 8%, you get a midpoint to maybe knock that down a little bit lower. That's a good trade too. Where do you think the stock's going to go, and what's your threshold? Okay. All right. Okay. Sam says that the more the market goes up, the more it will increase the risk. I think he's referring to the put prices would be changing if the market starts to go up. Okay, in his opinion, Sam, is there? Sam's going back to talk about the thoughts on the you know, bullish, bearish, or neutral comment, and you know, he says, look, we're about to hit the new highs again in the way that it's been moving and the way the pattern's been showing us. If it hits the new highs next week, there's probably going to be a pullback again. And of course, Sam continues on and says the nice thing is about stocks that they have no expiration dates, and having the put of more than 6 months out, if the risk is 7 to 8%. The most, that's the best. Yeah, I agree. I'm usually in that 6 to 7% range on my married puts as well. Just feels like that's what works for me, okay?